All right, everyone, welcome back to our part 2 of chapter 11. We're talking about individual sponsored retirement plans. So everything in the first one, you would have to work for an employer to be able to participate. They have to set it up. There has to be employer buy-in in order to do it. These, you don't need any employer. You don't need any other help. You can just set these up yourself. So we're going to talk about traditional IRAs and Roth IRAs. For both, the contribution limit is $7,000 or 100% of compensation. If you're over 850, you get all the way up, bump up by a whole thousand to 8,000. So right away, you should notice that individual retirement plans have a lot lower limit than any of our limits that we encountered in the employer-sponsored plan. So right away, you should see that there's a definite advantage to being part of an employer plan versus an individual plan in terms of being able to save a significant amount of money for retirement. So here's the challenge, okay, with anybody can put money into an IRA. Okay, this is a regular IRA. Traditional IRA, whatever you want to call it, okay? And it doesn't matter what your income is as long as you don't have another alternative. As soon as you work for an employer who has an employer-sponsored plan, that means you have limits on what you can deduct into your own IRA, because the basic idea is you need to just, if you have an employer-sponsored plan, that's where you should focus your attention, okay? If you don't, then yes, use an IRA. But if you do have one at work, then we're going to limit, okay? Meaning if your income goes up too high, then your contribution to the IRA is not going to be deductible. You can still make it. It's not like you're going to throw you in jail for making a contribution. But it won't be deductible, meaning you won't get any tax benefit now, okay? So that begins to phase out when you reach 123, if you're married, and everybody else is 77, phased out by $20,000 later at 143, and fully at 87 for everybody else. Married filing separately, the phase out starts at 0, so there's a definite penalty for married filing separately. You can still make non-deductible contributions. Okay, it's not like you can't make one, but it won't be a deduction. If you have an alternative plan and your income is over those thresholds, okay? So anywhere between 123K and 143K, if you're married, if you're participating in a plan and your AGI is between those two, then you could make a partial deduction. Okay, so if you're halfway in between at 133, then you could put in a deduction and take a deduction for $3,500. Now, I personally would only put in what I could deduct, so I would figure out how much my deduction is limited to, and that's all that I would put in. I wouldn't put the whole thing in if I could only deduct the part of it. Okay, and that's typically what people are going to choose. Now, what if you're married? Okay, there's some things that about IRAs. First of all, if both are employed and neither are covered on the employer plan, they can both make the contribution, right? So $7,000 for one, $7,000 for the other, total $14,000 unless they're over 50, and then it's $16,000. If only one spouse is employed, the other one stays home with the kids or whatever, and that person is not covered under the employer plan, okay? So the person who is bringing in income, the spouse, can contribute up to maximum for both. So it's kind of a spousal, what we call it a spousal IRA, because we don't want to penalize those that are not earning income because they're providing child care, okay, or dependent care of some sort. So that one that's making income can put in $14,000 to cover both of them, okay, as long as their income is over $14,000. if one spouse is covered under employer plan, okay, they have that limit that we talked about in the last slide, and the other is not, the not covered spouse, okay, so they're not covered at work, okay, they can put money into an IRA and deduct it up to $7,000 as long as that total AGI is less than 230, okay, and then that phases out, okay. So if your income is up to 250 total, even the spouse that doesn't participate at work still can't put their IRA in, deduct $7,000 for their IRA, okay. So if neither one works is covered under employer plan, the income doesn't matter for an IRA contribution. You can make each spouse can make $1 million if they don't have a plan, another plan available. They can put $7,000 in for each of them into their IRA. Now, looking at Roth IRAs. Roth IRA contributions are not deductible, meaning when you put it in, it has no impact on your tax return for that year. Correspondingly, when you take money out, okay, when you retire, you don't have any tax liability. So it's tax free when you take it out because you didn't get a deduction earlier. Contribution limits are the same as a traditional IRA, meaning $7,000 and $8,000 depending on age, okay? But you can't make the deduction that when your income is too high, you cannot put money into a Roth IRA. So unlike a regular IRA where income doesn't matter as long as you're not don't have an employer plan, Roth IRAs don't care about your employer plan. They care only about your income. Okay, so phase out starts at 230. Okay, and notice the backward thing, the phase out range for married filing jointly is only 10 and the others is 15. Usually it's the other way around, more for the higher limits. Okay, so if by the time you're at 240, married filing jointly, you cannot make any contribution to a Roth IRA. All right. And if you're halfway in between 230 and 240, 235, you can put half yours in. That's all you can. And there's fairly significant penalties if you put money into a Roth IRA that when you can't. Okay. So that's not something. And so typically people are not going to make their Roth IRA contribution until they know what their income is if it's anywhere close to these limits. Okay, here's just basically the idea of a traditional versus Roth. Okay, the difference. Traditional Roth, single individual with $58,000, wage of $30,000 can make a tax deductible contribution up to $8,000. They're over 50, so they get up to $8,000. Whether they're single or married or whatever, it doesn't matter as long as they are not participating at work. Now, in this case, their income is low enough that even if they did participate at work, they could still deduct their full IRA contribution because they're not close to the limit. $250,000, okay, an eligible to make deductible contribution to a traditional IRA. No, they can put it in a traditional. Where they would have a problem is putting it into a Roth IRA. Okay, distributions from a Roth IRA generally are not taxable. That is true. Okay, even if they're not. You can usually take it out as long as you put money in, leave it in for 5 years. When you take it out, the income could be taxable, but not what you originally put in. Okay, I'm going to talk a little bit more about distributions a little later. Now, there's some other plans that work kind of like IRAs, but they're not. These are more for saving for education, not for retirement. Okay, contributions are not deductible like a Roth IRA. Count gross tax free. You don't have to pay taxes on the income while it's making it in there. And distributions are not taxable if used exclusively to pay for higher education of the beneficiary. Okay, Any person can establish and fund a CSEA, a Coverdale education savings account for any person, themselves included. But problem is, you can only put $2,000 in per beneficiary. If you have 4 kids, you can put $2,000 in per kid. Okay, but if anybody else wants to put money into that plan, they can. If you put the 2,000, it's 2,000 per beneficiary. Okay, so grandma can't put another 2,000 in. She's limited to putting in whatever you didn't. Okay, you can't make the contributions because the contributions are tax deductible, so they can't take away the tax deduction. They can just tell you can't do it when the AGI of the contributor reaches 190. Totally phased out by 220. Okay, and 95 for everybody else. Totally phased out by 110. So if you have 220, you can't do this one. Okay, you can't put the $2,000 in. If you're under 190, then you can, and in between you can put partial, right? Depending on how far in between you are. Qualified tuition plans have become far more popular than the CISAs. Okay, they were kind of a cool idea, and then the 529 plans came along, and this made the CISAs kind of obsolete. Okay, earnings grow tax-free. That's the benefit. It can be used for qualified education expenses, a wider variety than even CISAs. Qualified expenses, tuition, mandatory fees, books, supplies, equipment, computers, software, and room and board if they're at least half-time. Okay, so a pretty broad thing. And you can put in a lot more. It doesn't have the $2,000 limit. So I can put it in for my kid, and I don't have that $2,000 limit. So it's still not a deduction currently. So it's not like regular IRA. It's more like a Roth IRA. But it can grow tax-free or tax-deferred. And it should be tax-free because on the earnings, because as long as you use it for education. You can even use it for pre-college. At least $10,000 per year can be used for tuition. Okay. Also, multiple people can put it into the plan. Unlike the CISAs, which is limited per beneficiary, other people can put money into the plan as well and doesn't count against. There's really no maximum. Okay. Non-qualified distributions are taxable and subject to 10%. Okay, so don't take it out to use it for somebody else. You can put money into for one kid, and then if they don't need it because they get a scholarship or something like that, then you could roll it over to another family member, even to a cousin or a nephew or something. They can even be rolled into the Roth IRA. Say that you put a bunch of money into the plan, kid goes to school, gets scholarships, doesn't need it, you don't have another child to roll it over to, you could roll it into a Roth IRA for that child for when they retire. You can put your $2,000 into the CISA and put more money into the Q-tip, okay, or a qualified tuition plan. You can claim an education credit or tuition fees deduction. Oh, that's gone away, the tuition fees deduction, and the QTP withdrawal as long as the same expenses are not used more than once. Meaning, if you have money in this plan and your kid's tuition is $10,000, you pull money out, say $5,000 out of the QTP plan and pay the tuition. That means you had to come up with another $5,000 to pay the tuition because the total was $10,000. That other $5,000 can get you the education credits that we talked about in Chapter 9. Okay? The AOC credit, okay, any of those tax credits for tuition, but you can't use the $5,000 that you pulled out of the account and take the credit on top of that. You can't do it double dip, but if you have enough expenses, you can do both. Okay, Coverdale Education Savings Account are not deductible. That's true. $2,000, true. Phased out at 95. That's pretty, on the lower side. Whoops. And you can use it for a computer for the Q529 plan. All right. Pulling money out of a qualified retirement plan. Generally, distributions are taxable if contributions were deductible, right? Regular IRA, traditional IRA. When some but not all contributions were made with previously taxed dollars, they will be partially tax-free and partially taxable. And you use a simplified method. This is in your actual chapter, not in the appendix, okay? The simplified method is in the, and this is only used when you have a mix in a plan of things that you've already paid tax on or not. For instance, remember when we talked about the idea that you could put money into a regular IRA, even if you have an employer-sponsored plan, okay? But part of it, you could put the whole $7,000 in, but only some of it might be deductible because of your income. Well, if you go ahead and put the whole $7,000, and then what you've got in that IRA is you've got partially a deduction, and that dollars is taxable when you pull it out, and the other part is not deductible when you put it in. So when you pull that out, you shouldn't have to pay taxes on it. So how do you split that up? You use the simplified method, okay, which is in your textbook in the chapter. So you look at the table that's shown on page 11-16, at least in my physical book. Okay. Determine the total contributions for previously taxed dollars. Those are the ones that you put in without getting a deduction for it. Take that dollar amount and divide by the number you get based on the age from the table, and that's how much of the payment will be tax-free. Okay. So whatever amount you're going to get is you're going to not have to pay tax on that percentage of it. Okay. Or that amount of it, I should say. It's going to be an amount, not a percentage in this case. All right. Now, IRAs, 401ks, all these other plans have what's called a required minimum distribution. And now starts for us now at age 73. So when you turn 73, the government has a rule that says you have to start taking money out. You don't care if you could still be working, you could still need the money. You cannot just leave it in your IRA forever. You have to start taking money out, okay? And you have to take it out over the time period given by the life expectancy tables. In this case, table 3 is the one you should use from the IRS to determine your retired minimum distribution. That's in your appendix to Chapter 11, not in the actual chapter. It's in the appendix. So you figure out how much you have in your account. You divide by the distribution period listed based on your age, and that's how much you have to take out. Okay, and required distribution. So if you are 74 and you have $1 million in your plan as of the end of last year, this year you have to take out $1 million divided by 25.5 according to the table. Okay, Roth IRAs distributions are generally not taxable. If you pull it out early, say I can't afford to not have this money. Roth IRA pulling out is very generous. The earnings that you've made during the 3 years that was in there, for instance, is taxable if withdrawn, but not the amount you originally put in. So you're not paying that much of a tax or penalty. Okay, as long as you use it for pay education, all the education plan things are not going to have any tax implications. Okay. You can, as long as you have more than enough expenses, you can use a withdrawal and still qualify for the credits for other expenses. If you pull money out early, not according to the rules, in a regular IRA, or a 401k, you're going to have not just the income tax, okay, you're going to also have a penalty, and that can get still only 10%. And then there's a whole long list of exceptions. They keep adding to this list. This list is now the longest since I can remember. It used to be 4 or 5 exceptions. Now we've got a whole page of them. So rather than list them all on the slides, send you to page 1119. Rollovers, if you take it out from one trustee to another trustee, that should not be taxable, right? You didn't ever get it. You just take it from one bank to the next. If you roll it over and put it in a Roth IRA, that is taxable, okay? If you pull money out and then decide, oh, I really just want to roll it over and put it back in, you got 60 days to put in a new plan. Otherwise, it's taxable, okay? So typically, if you just call up your bank and say, move my money, my IRA from your bank and to this new bank, and you give them the information for both sides, they do what's called a trustee-to-trustee transfer. One bank just sends it to the other bank, and you'll get a notice in the mail that it happened, but it's not taxable, and they won't take any tax out of it. If you take it out and don't tell to put it into another one, they're going to do a withdrawal. They're going to do withholding from your IRA money. And so it's going to be hard to roll it over into the new plan because you're not going to have it all because some of it is sitting ready to pay their taxes. Okay? All right. Participant in a defined benefit plan is entitled to only a stream of payments. True. Okay? That's what the promise is. That's clear back from our first thing. Distribution qualified pension plan may be taxable, non-taxable, or both. Yeah. Depending on if there were payments, contributions that were made pre-tax or after tax, then it could be a mix. Okay, anticipation payment, the simplified plan. If you pull money out of a pension plan that has a mix of taxable and non-taxable parts in it, and you're 68, then the table in your textbook it shows that you're going to get 210. You take the amount of non-tax, the stuff that's already been taxed, divided by 210, and that's how much you would not have to pay tax on. Again, using the same table, change the age, and now the married table is 310. Okay, distributions are required from a traditional IRA. That is true. Starting at age 73. They've been talking about moving that up again, but right now it is 73. It used to be 70 and a half. Now it's 73. I would assume in the next couple of years it will move a little higher, but right now it is still 73. And you have to do it. Now, you do not have to do that with a Roth IRA. Okay? IRA distributions are taxable, funded with deductible contributions. That's true. And distributions are never required from Roth IRA. That's what I just said. You don't have to. Because the government doesn't care. Okay? You don't pay tax on the distributions anyway. See, they want you to take money out of your IRA because that's the way they can charge you more tax and get more income. As long as you hold it for over 5 years, all of your are not taxable in an Roth IRA. And distributions from Coverdell Education Savings Account can be used for any purpose once the beneficiary reaches age 30. No, that is not true. They do not have as much flexibility as those qualified 529 plans. So you've got to either roll it over to another beneficiary, or you've got to take the money. If you want to take the money out for some other reason, you're going to pay you're going to have taxable consequences. And finally, we just have a couple slides about annuities. Remember, we talked about a series of payments, usually a contract. Typically, what you do is you make an investment in your annuity with a bank or an insurance company, and they promise to pay you a series of payments. So you put it in there, and they say, okay, we'll give you a certain amount of money for the rest of your life or for the next 10 years. Okay? So how much? So some part of that is taxable. The part you put in is not taxable. The part that represents income, because you've put in so much and you get back more, is taxable. So we have to split it. Okay, so you take what you put in is the cost of the annuity. The expected return is how much money you're going to get per month times 12 times how many years you're going to get it. So if it's a 10 years, then you know exactly how much you're going to receive. If it's a lifetime annuity, then we're going to use another table. So we already used table 3. That was for required minimum distributions. We're going to go to table 5, which is on the next page in your textbook. That is what we're going to use for annuity contracts, okay, as far as the years. So if it's a lifetime annuity and I want to know how much I'm going to receive, it's how much I'm going to receive per month times 12 times the number of years it tells me based on my age. Okay, you see the multiple. So you divide the cost by the expected return, and that's a percentage that you're not going to have to pay tax on of you get from each month from the annuity. Okay, so this is how the annuity calculates the expected return. Okay, either a specified amount of time, 10-year annuity, or rest of your life, which we go from the table, and then some quick check questions. Annuity payments are always the same amount each period. Typically they are, but they don't have to be. Okay, they may be adjusted for inflation or some other thing. Annuity payments often have a taxable component and non-taxable. That is true. Most of the time that there is some of both.